Tushar Pradhan, the Chief Investment Officer at HSBC Global Asset Management Company, is joining us. Good morning, Tushar. As always, good to have you with us. What's the sense now? Is it the right time to step in, or does it look like the markets have now fully valued all the good news?
Well, that depends on how long you look far into the future. I think if, as you mentioned, if it's between the medium term and the long term, I think clearly this is a great time to be investing. Simply because of the fact that, of course, we've kind of come down significantly from the peaks that we achieved a couple of years ago. So intraday was almost 30,000 for the Sensex. And from then we have taken a significant drop. And if you look at the earnings growth potential that this country can have in the next 2 or 3 years, I think that makes the market a fairly attractive proposition. But I think today's upsurge obviously comes from the fact that the Fed has kind of kept a dovish stance to most observers, and as a result, I think markets are reacting.
Okay, and from here on, do you expect the rally to continue? Because there were a lot of, at least retail people were skeptical in this rally from 6,800 to 7,500. But now that it's sustained, would you recommend that people can go ahead and buy if they just have a 6-month time horizon?
Well, that's again a very generic statement to make. All I'll just try to focus on is the fact that if you look at earnings, it's been something which has not really progressed further. So the quarter ending December has not really generated much interest in terms of earnings revival. I believe the way the provisioning for the banks will likely go, as well as the other inherent problems of lack of growth in our economy, will again point to a very weak quarter ending March, which means in a few days' time when we go into the full financial year, we should be not surprised at the fact that earnings will be weak. So I think there might be volatility in the market once we get those numbers. But I think that is not a reason for people to get disheartened. I think 2 or 3 positive things that we need to concentrate on is that the next year on a base effect will substantially increase the earnings number. And if you give this economy another 12 months, I think the real revival will begin post that. And then you will have another year of pretty significant earnings growth on top of what you will see optically for FY17. So I think if you're looking at pretty robust earnings growth for the next 2 years as a result of these 2 actions, I think the market seems to be pretty optimistic from my point of view to enter. However, as I said, volatility is clearly going to be the case for the next quarter or so, even if maybe even 2 quarters, simply for the fact that the real numbers are not likely to be seen in this earnings season at all.
That is exactly what I was coming to. You're sounding confident about the proverbial green shoots. When will they really emerge as slightly longer bushes? Would it be first quarter of next year, second quarter of next year, second half of next year?
I think you will see the first numbers pick up come only in the second half of next year, is what my opinion is. Simply for the fact that if you look at the YOY comparison, the third quarter financial of the current financial year, as well as this last quarter of this current financial year, there has been a significant drop in earnings growth vis-a-vis the year prior to that. And when you look at a base effect, even if you assume a normal sort of recovery, or even for the fact that the volumes will start adjusting to the slightly higher prices that we may see this year, you will see a pretty substantial jump in earnings growth only in the second half of this financial year. So again, as I said, these recent numbers, the ones which will keep getting printed for the next couple of quarters, are not really something which will excite the markets, and as a result of which I believe the market will remain volatile. And there is no reason to kind of believe anything so far because the numbers will not show up. But the base effect will start working only in the second half of this year, and then hopefully the economy turns around and you'll really see true earnings growth in the FY18 financial year.
Oh, really? So even in the third quarter next year, you're only expecting a base-related improvement in earnings. Economy turning around is even further out?
Absolutely, because what is really happening in the last couple of years is there's been a lot of public spending. We are seeing orders being spread either through the roads or the rail areas in the economy. That is going to translate into top line for companies only once the orders are actually with a company and they start reporting those completions on a quarterly basis. The margins continue to be under pressure because either these companies are leveraged or the fact that there are certain issues of growth otherwise, apart from just these public expenditures. So what we are hoping to see is that this kind of activity starts reflecting in the numbers optically in FY17, and then slowly it starts to get into real numbers in the year after this. So again, what I'm trying to say is that the market doesn't really look at the realness of the economic growth. It does look at reported earnings, and reported earnings are likely to jump pretty substantially in the second half of this financial year, the next financial year, that is FY17.
Okay. Tushar, I was seeing a couple of your fund holdings and I don't see a lot of energy in it. Now, we've seen commodity prices, crude prices, recover quite a bit from their earlier lows. Is it time to change the underweight or cautious stance in energy sector as a whole and on individual stocks?
Well, I think that's a little bit of a difficult question to answer, simply because in energy there is upstream and there is downstream. Most of the fortunes of this industry are not fairly uniform across upstream and downstream. We do believe that given the fact that the production of crude oil in the world is continuing at a very, very fast pace, we've already come to a point where there is difficulty in storing inventory. Now there is not enough oil to be stored anywhere. That is likely to sustain the low prices in crude the world over. That will mean that any resurgence in oil companies reporting something differently globally than what they've been reporting for the last year is unlikely to happen right now. And that might translate into lower commodity prices for the entire globe for a year or so. So having said that, I think I would still think that's a little early to kind of venture into commodities.
Okay, so what would you venture into right away? Would you buy the economy stocks like banks, or do you stay on the sidelines with defensives for now and move into the economy stocks closer to second half?
Again, it's difficult to kind of make a very far-reaching broad statement here, because when we talk about defensives, obviously there's a lot of valuation risk there. So while there might be some security in earnings growth or the fact that cash flow will be pretty strong, the fact is valuations don't really make it attractive. So on the whole, what I'm trying to say is that we should look for early beneficiaries of an economic cycle turning around. And that is not really a very simple thing to point out to say, well, this sector actually does this or that sector does it. I think we need to be a lot more bottom-up. We need to understand that the first initial improvement in the economy is going to benefit what company rather than a sector, because they can be diverse. They can be a company in light engineering which might benefit. There might be a company in the road sector which might benefit. There might be a company in textiles which might benefit because of what has happened largely as a demand increase also in this quarter. Whatever the monsoon will bring about will also lead to its own discoveries in terms of where companies will go. So I think from a stock picker's perspective, this is an interesting time. These are not very easy times to find such companies as you mentioned. But I think there is enough opportunity. One takes time to research these things.
All right. Thanks a lot, Tushar Pradhan, for joining us. We have to end this interview because Shaktikanta Das is